Today, we're excited to welcome Steve Dick, mortgage officer with Guild Mortgage. Steve offers a wide range of loan solutions and has been in the business for over 25 years. From down payment assistance for first-time home buyers to government-backed programs for military families and rural communities, as well as jumbo loans for high-cost markets, Steve does it all. What sets Steve apart is his commitment to working with clients well beyond the closing table. He helps homeowners develop long-term financial strategies and uses innovative technology to stay connected with both clients and financial partners. His expertise includes loan origination, deal structuring, pre-underwriting, credit repair, and compliance management. Steve holds a Bachelor's of Arts in Criminal Justice from the University of North Florida, and beyond his work in lending, he's deeply involved in the community alongside his therapy dog, Biscuit. He visits local schools and veterans' homes, giving back in the meaningful and heartwarming way. Steve, welcome to the show, and thank you for being here with us today.
And somebody did their research.
Thank you for being, and happy Father's Day. I know Father's Day was yesterday, so you do have a daughter, correct?
Two
daughters.
Two daughters.
How old are they?
25 and 20.
Oh, wow.
Did y'all do anything special over the weekend?
Not really. Sarah was gone, but, Christina and I cooked a little meal last night, which was fun, and it was a good time.
That's amazing. So I want to hear more about your dog, Biscuit. I know we're here to talk about lending, but I know that you've been doing this therapy work where you visit veterans' homes, where you go to schools and provide reading.
Yeah,
Can you tell us a little bit more about that?
Biscuit is a genuine rescue dog. We got him from Adopt a Golden in Birmingham. I have pictures of him with bite marks going up and down his neck because he had been on the street for so long. And when we brought him home, he went after the other dogs. We were like, uh-oh. But he had been on the street so long that he was resource protective. And we've got this wonderful trainer, Heather Sleeper, and she came over and she's like, once we get the resource thing taken care of, his personality would be great for a therapy dog. He does not lick, he does not jump, and he goes to the schools, Lynn Haven Elementary, where my wife works, and the kids love him. They will hug on him, they will read to him, they do great. And then you'd bring him to the veterans' homes, and they're just remembering their dogs when they had a dog, and I'd love to say it was all my great training, but he just knows when to get closer, when to back off. He's just great.
That's amazing. Yeah, I think we had a conversation with you a while ago because we have many conversations. We work together. But one of my just favorite memories of middle school was when the basketball team, we went to like the veterans home and I think we colored something for them and
Right.
Just having that interaction with veterans. And then now you're bringing your dog there. I'm sure that just makes their whole week.
It does. We do it with a group called the Alliance of Therapy Dogs. And okay, kids, if you have a really calm dog, contact Ernie with Alliance of Therapy Dogs. And we're always looking for more dogs.
Steve, what is a therapy dog?
It's not a service dog. A service dog is an actual working dog, maybe for somebody that's blind or has seizures, and you don't ever want to approach those dogs. Our dog, when we have him out in public, it says right there on it, therapy dog. We want you to approach him, pet him. His whole purpose is just to bring comfort. He doesn't know any great tricks, but he's great.
That's awesome.
That's awesome. And I know your wife, Kathy, she's a speech therapist,
At
correct?
Lynn Haven.
That's amazing. So I know Heather mentioned you got your criminology degree. How do you go from that to, how do you get into lending? What inspired you to get into lending?
Well, I got into criminal justice because when I got out of high school, I wanted a degree that didn't require a lot of math and didn't require a lot of writing. So I was like, okay, what's my easiest way? And I was like, yeah, I'll do criminal justice. That's rote memorization. I can do that. So I did that with the intention of going to law school. And then I saw the cost of law school. I was like, well, I'm not doing that. So I took a job with a finance company, got transferred to Panama City, My office was doing really well. They gave me a company car and I won a trip to Vegas. And then we got purchased by Bank of America. And I was like, awesome. We just got purchased by one of the biggest banks. So I sold our other car, used that as a down payment for our house. And then a couple months later, Bank of America said, hey, we're shutting down all the nation's credits.
Wow.
I was like, oh. So now I'm in Panama City with no job, a house, no friends, no family. I was like, oh. So that's how I got into the mortgage business, desperation.
Gotcha.
Where are you originally from? Jacksonville or?
Orange Park, Jacksonville.
Okay.
Dad was in the Navy, so we were everywhere, but primarily Orange Park.
And so you got into a profession where you actually utilize a lot of math.
Yeah. Well, the computer does a lot of the math.
What's driving current interest rates, and where do you think they're headed?
So first, anybody that says they really know, they're lying.
Yeah.
Mm-hmm.
Most people thought the last 2 years that the rates would have touched into the fives by now. But the uncertainty over tariffs are by definition inflationary. If we have something that's inflationary, it will drive up interest rates. Now, if we get all the treaties with all the various countries and give the market some certainty, that'll help. But the other thing that's just killing us is our national debt. Right now, we're spending more on our national debt than on our defense. That is not a good recipe. So we have to have a president that eventually cuts down on spending and reduces, all these programs. And it's going to hurt and it's going to stink. But if we don't do it at some point, there'll be a big price to pay.
Yeah, that's right.
I mean, the interest just on the national debt that's what you're talking about, right? Yeah. It's just astronomical. And it's just growing.
Real.
By the minute. I think there's a clock that you can actually Google, like the national debt clock. And it'll give you anxiety.
Yeah.
Have you seen this,
wow.
Heather?
No, I haven't.
You don't want to.
You don't want to, but
I
I did it once, and that was enough for me.
Yeah.
But I think obviously with the Fed, last time we didn't get a rate cut, they just remained things the same. A lot of that, the reasoning for that, I guess, was there's a lot of uncertainty in this tariff, obviously. So there's people saying, okay, we might, get a rate cut in September, but who knows?
And we probably will. Mm-hmm. But originally they forecasted more rate cuts. Now they're being much more conservative. The problem with the Fed a lot of times is they're always looking in the rearview mirror. Mm-hmm. They're not going to do anything until they have all this data coming in. But a lot of times you can already see it. It's happening. But we're waiting months and months to do something that we know we should have done a long time ago. Kind of like years ago when the rates were so low, and the Fed said that the inflation was transitory. It wasn't. But we waited so long to move the rates up that it caused a lot more pain.
Yeah.
So it's not very forward thinking, whereas our job right now is all about forward thinking.
Yeah. What's going to happen next?
So are you seeing rates, like what are you seeing right now for FHA? Are you seeing them in the sixes? Are you seeing them in the sevens?
You're getting between sixes and sevens depending on your credit.
Right.
Everything revolves around your magic credit. 600 guy gets a different interest rate than 740 guy.
Right.
And should. One has earned a better rate.
Are you seeing an uptick or a slowdown in mortgage applications right now?
This has been a weird year. It's very start and stop.
Yeah.
Like, I'll get a bunch coming in, and then it's like, is my phone working?
Right.
Yeah.
And then suddenly the phone starts ringing again. And even the news clips you see, like, that comes into my Google feed showing, hey, rates went down today, but they actually went up that day. But they're giving you information based on yesterday.
Right.
So.
And I think, too, and you have a business, like we have a business, there's a lot of people in your space. and it's competition. Like with us, like we have to constantly compete. CPAR, we have over 2,500 realtors. There's quite a bit of lenders, but I think with you, what sets you apart, well, you can tell me obviously, but from what I've experienced with our business relationship is your knowledge and just being on top of things like you just said, like what the rates were yesterday are not the same of what they are today, and it affects everything. So what would you say is what separates you from other lenders? Why does somebody want to work with you?
At this point, I've had a lot of at-bats. I mean, I have seen
I love that analogy.
thousands of applications. I mean, literally thousands. And so you get to a point where okay, I can fix this person or I can't. A lot of times, if a lender turns you down, they turn you down, that's it. If you go and you look at some of the Google reviews, you'll see there's been people I've worked with for a year, 2 years, 3 years. I'll put in the time with them, and I will bring them back to the original realtor. Hey, Casey, Jimmy Lipper, he's ready now. But if they're not going to do the things, then I'm going to let them go because there are too many people that need help.
Yeah.
That's awesome.
You've been on board with quite a few of my customers and buyers.
Yes, you've had some special friends.
Yes. And I appreciate how hard you work because you're always updating me on what they need or what we can help with. That also gives me the ability to touch base with them and help them along with that process. Sometimes it works out, some things we can't help, but sometimes
and we just closed somebody we've been working with
3 years, I think.
Yeah, 2 or 3 years.
Yeah. And she's happy.
And it doesn't even matter the size of the loan. You work the same, whether it's $150,000. I mean, I feel like you work harder. Like the mobile homes that we have been able to push through, Steve, and I'm so sorry I brought those to you. But I just knew you were the guy because you just care, And then even with our conversations, there's stuff that you say to me. I'm like, whoa, back up. What does that mean? And one of the points is recasting. Yeah. I had no idea what recasting was prior to you bringing it up to me and explaining that. So for people that don't know what a mortgage recast is, can you explain that process and why it could be beneficial for a buyer?
Recasting is really cool. It's only for conventional loans, though. You can't do it VA, FHA, or rural development.
Is that across the board? It's only for conventional?
Yeah.
It makes sense because FHA, you would get maybe a lower interest rate. Is that why?
No, I actually don't. I'm not exactly sure why it's only conventional. But usually the cost is $250 to $500 depending on your lender. And generally how it works is this. Let's say you came into some money, $20,000, $25,000, $50,000, whatever, and you're like, hey, Steve, I want to refinance and lower my payment. I get it, and that'll certainly help me, but you could do a recast, put your $50,000 down, and what the lender will do is they'll just re-amortize your loan for whatever's left. So if you've been in there for a year, they're only going to re-amortize it for the remaining 29 years. They're not going to go all the way to 30. But let's say, well, again, Heather and I just closed a loan, and the buyer was approved to close without selling her home. And one of the things I told her is if we close your house now, and then you sell your house a month, 2 months later, you can still take the money, put it down, recast it, lower your payment, and now you're not paying 4 to 6% of your loan amount for a refinance cost.
So you're saving thousands of dollars.
Listen, you could be my sister, and no matter what, you're going to have doc stamps, intangible tax, title work, appraisal. You don't do that with the recast.
Well, that's
So
good to
part
know.
of it is just planning and preparation and letting them know, hey, here's the deal. Now I wouldn't do it for $10,000,
Right.
Because that's only going to probably drop your payment $50.
Right. And, I have customers that were, after I spoke with you about this, I told them about this because essentially they were in a similar situation where their house was paid off. They don't necessarily want to buy a house contingent on the sale of that. So, say they want to buy a $500,000 house and the house that they're living is worth $300,000, let's just say hypothetically. They can go ahead and get into that $500,000 house. Now their payment's going to be $4,500 or $5,000 a month, right? But then once they sell their house, let's just say $300,000. Obviously, that's let's just say $300,000 net. which it probably sold higher after closing costs and everything like that. They can take that 300, throw it at that 500. Now you
Yes.
have 200, recast it. Now your payment is what? 2,000,
Yeah,
2,500 a month?
so much less, and you saved all that money.
Right. So,
Is there a waiting period from when you purchase that property to when you can recast?
Not that I'm aware of.
Okay.
Not that I've been told. I
And
could be wrong.
that solves the problem of home sale contingencies right now. You don't, the market, there's so much to choose from. Average days on market are around 90. You don't really know when your home's going to sell.
Right.
So,
yeah, it's definitely a dance right now
Yes.
with that. But
yeah. Steve, what's the difference between pre-qualification and pre-approval, and how early should someone talk to a lender if they're thinking about buying in the next 6 to 12 months?
So that's actually a great question. One of the things, if somebody's buying in the next 6 to 12 months, it gives them a chance to go to something called optoutprescreen.com. That's www.optoutprescreen.com. What this does is you can go in there, choose the automated opt-out, and it will remove you from trigger leads. I am sure you guys have had a customer that you've sent to me or somebody else. I pull their credit and they have 200 different lenders calling them. That's because the credit bureau, which I just paid for, the nice people at the credit bureau turn around and sell the buyer's information to all the other lenders. And so that's why you will have some angry clients because their phone is getting blown up. And it doesn't matter what we do, the information's out there. So they do the opt-out pre-screen. That's step one. That'll keep them from the trigger leads. Now, the pre-qualification I like to get done as early as possible because I don't want to be working with Heather and she's like, hey, listen, I'm going to be ready in 6 months. I'm like, okay, well, let's take a look now. No, I'm good. Well, then when you're ready, I finally get to pull your credit and I'm like, Heather, what about this? I could have had a whole 6 months or a year to clean up whatever the problem is. And as for your other part of the question, pre-qualification, because I know a lot of times realtors are like, I don't understand. They were pre-qualified. What's the problem? When I'm talking to the buyer on the phone, they're saying, hey, I make $5,000 a month. I have this much in the bank. They're giving me everything over the phone. I put it in the system. It spits out, yes, we'll do it. I haven't seen their pay stubs yet. I haven't seen the bank statements with the 10 bounce checks or NSF charges a month. And then it turns out, well, they're self-employed, and while they gross $5,000 a month, their tax returns show they lose $2,000 a month. So the difference is pre-qualified is what we're doing over the phone. Pre-approval means somebody's seen it. I've seen it. Hopefully the underwriter has seen it, reviewed it. And then what happens is I've got the borrower approved. And now it's more like, okay, now we just have to find the house and get the house approved. So particularly now, I try and get as many of the buyers pre-approved as possible if they're going to be looking a little bit. It's like, okay, let's get you in. And that also makes a stronger offer because I'd like to think if you're a good agent and you're looking at a couple offers and they're kind of similar, they're going, oh, okay, Mr. Seller, this one here, they've already been pre-approved. Underwriter's already seen their zits.
Yeah.
right.
You know,
Yeah.
we know what's wrong with them.
Right.
Are you pulling credit for each one or just the pre-approval? When are you pulling credit to actually, because
So
on that same line, what credit do you have to qualify for a mortgage loan?
So we pull credit on the pre-qualification. And then usually that credit's good for like 4 months. Now, what I will sometimes do is if that person, let's say they find the house in 3 months, 3.5 months, and I know it's closing after that, I'll go ahead and pull their credit right then and there because I don't want to have any surprises because I just had one where we did that. My buyer, we had him pre-approved. It was a ship loan, and he finally found the house. I'm like, your credit's going to expire. I'm going to re-pull it.
Mm.
He hadn't made his student loan payments since January.
That'll do it.
And so we had a 100-point crash.
Mm.
Now, nobody was like, yay, Steve. But imagine if I had waited and now money's been spent on appraisal, title work, survey, home inspection, all the things, everybody's time, seller's ready to go. Now you pull the credit and it's like, ruh-roh.
Right.
Yeah.
So even though nobody's excited about it, it's better to find out early than late.
Absolutely.
Yeah.
Yeah, she just had one. That,
Yeah.
Yeah.
It wasn't you.
Think on
But another lender, I had the listing and another agent had the buyer. It was just, it went so smooth all the way up until
it didn't.
Yeah, until it didn't.
Yeah, smooth until it didn't. Yeah.
3 or 4 days before closing. And I think they found it the 4th day. They told me the 3rd day before closing. They had not verified the buyer's income. And the buyer needed a certain amount time frame of income, and they were missing like 3 or 4 months of income because they hadn't verified it. Because when they went to go verify it, the people he worked for would not provide either a 1099 or a W-2 to verify it. So anyway, it fell apart. But that's why it's so important to have a great lender who's going to do all that beforehand and catch all of the speed bumps.
It's so gut wrenching
Before that
when you
money.
have to put that property back on the market,
Yeah.
especially explaining everything to the seller.
That, and to Steve's point about all the costs, the appraisal, home inspection, WDO inspection, that buyer's out all of those costs, but also he lost his earnest money deposit because they went over the loan approval period. So that earnest money deposit was forfeited to the seller because we were basically at the 3-day disclosure period is where we were.
That's a nightmare.
Yeah.
So what credit do you have to qualify for a loan?
There's no set amount.
Okay.
You give me great credit, I can do one thing. You give me great down payment, I can still do stuff. So we've gotten people with 550 credit scores closed
Wow.
because maybe
That's
they had a
incredible.
chunk of change. You know, whether it's through the SHIP assistance program and inheritance. So a big chunk of down payment forgives a lot of sins. Because lending's like anything, it is graded.
Mm-hmm.
So, okay, you don't have great credit, but you're putting a big chunk down. All right, we can play ball with that. All right, you don't have a lot of money down, but you've got really great credit and you've always paid your bills. All right, we can work with that.
So it's basically a case-by-case basis.
It is.
And
It is. There's no set formula, which is why I tell everybody, just bring them to me. Let's have a conversation.
Yeah.
Figure out if they're going to be buying today or tomorrow.
Can you explain why it's so important to inform buyers they get excited, get under contract, oh, we're a week out, let's go furniture shopping. Or let's go car shopping.
Yeah.
You know,
Yeah.
we're on this high, we're going to ride this high. Can you explain why you shouldn't do that?
Okay, so you're forgetting the other one that you and I had.
We've had so many.
Let's not switch jobs in the middle.
Oh,
Yes.
Yeah.
Without telling anybody. If you're gonna switch jobs, at least give us a heads up so we can.
Yeah.
Because I feel like it, and that's the thing is to have good relationships with your lender, with your realtor. Open conversation is key because like if we find out after the fact, it's really hard
Yes.
to make it work. But if hey Casey, hate my job, I told him to pound it. Okay, let's figure this out, But we found out about that after the fact, and that
Yeah.
was hard.
He did tell him to pound it.
Yeah.
And
Hey, we got through it.
yeah.
it closed.
Yes.
It did.
Nice.
It
Yeah.
did.
Even with a job change.
Steve,
That's awesome, Steve.
I give Steve all the good ones.
Winner, winner. Yeah, that one was fun. The I tell them all, think of me as the priest or the bartender. I don't care which, but confess your sins.
Right.
Let me figure it out, and it's a whole lot easier for me to fix it before you do it than afterwards.
Yeah.
And as far as if you go out there and you get a new car payment or you buy the furniture if I've got your debt ratio at 49%, zoinks. That little difference could take you between approved and not approved. When you do something here's what we've got you approved at, and then you add something to the pie, pie may not taste good then.
Steve, what's the ideal debt ratio? 0.
I like it when the front end, which is your housing expense, how much is your house versus what you make? I like that around 28%. And I love the back end, which is all your other debts. And by debts, I mean stuff that's on the credit report. I'm not talking about electric and all that. I'd like that at 41%. That being said, you can get loans up to 50, 55%. Again, that goes back to, okay, this guy has really good credit. Or, everything is kind of a scale.
Gotcha. Weighed and taken into consideration.
Yes.
Can you explain the debt to income ratio for people that don't understand that?
Sure. If I'm making $1,000 a month, then I want my mortgage payment to be between $200 and $300. And then if I've got another couple bills, I want that to be totaled with the house payment no more than $400, if possible. Again, there's variance, but $400 of your $1,000 income, that's your 40% right there.
Because you have to have other, as a
Right.
lender,
Eat.
people's got to eat. Groceries are high right now, so all
Right.
that's factored in.
Steve, there's a lot of talk about the SHIP program and programs out there for first-time home buyers. Can you explain what the SHIP program is and what it offers buyers?
Yeah, the SHIP program is amazing. I know some realtors do not like to deal with it, but it's a fantastic program. The county currently has between $25,000 and $50,000 available, depending on your income. And you can use that money for down payment and closing costs. Basically, without going too far in the weeds, say you got the $50,000, maybe you'd put 40 down, use 10 for closing costs. And then on top of that, that program is forgivable. If you stay in that house at least 6 years, it starts being forgiven at 10% a year. So if you're in there 15 years, the whole amount you received for the assistance is forgiven. Realistically, most people aren't going to stay in there. What is it, like 7 to 9 years is the average?
Yeah.
But still, that'd be a pretty good chunk of change off of your assistance.
Or you could just, if you want to move on, maybe rent that out. Is that an option with
No.
that? Okay.
No, it's for
Okay, so
primary
primary
residence.
okay.
It's not for, hey, I'm going to turn this into my rental portfolio.
Gotcha.
And then the city has a great program as well. So you're talking about a lot of money that can really, it's life-changing. It's life-changing amount of money for people that need that assistance. And there are some that get upset that they have to pay the money back. I'm like, well, I don't understand. You're just giving it back so the next guy can use it.
$50,000. If say you're pre-approved for 150, that could potentially put you up to 200,000, depending on liquidity and how much money they have,
Right,
for closing costs. But
where you're like with the city program, I try and put a lot of their folks through the new construction because they've got some lots, and if you've got a buyer, you might be able to get them on one of those lots, and then they do a brand new house. But now I'm able to get them homeowners insurance based on a new house.
Yeah.
And if I find a brand new house, my insurance might be $100 a month. If I find a home in the Cove, that bad boy
Triple.
might be $300 to $400. Well, that $200 difference in insurance premium, that's probably $40,000 in buying power for the borrower.
What are some of the hurdles if someone's getting the SHIP program that they'll have to go through with?
The biggest thing is that bad boy has to be move-in ready. If there's a problem with the house, it's going to have to be fixed. Now, again, sometimes it's a little bit of a scale. The reason SHIP is so stringent on the inspection is if you've got somebody who's getting $40,000-$50,000 in assistance, they probably don't have a lot in savings where, okay, the roof is going to need to be replaced, the AC is going to, they just don't have that kind of cash right now. The hope is that things improve through the years and you've got that. So they want it to be ready to roll. So that's why the new construction on the city side is so great, because those homes are going to be, hopefully pretty maintenance free, at least for a while.
Is the city fully forgivable too after a certain amount of years?
15 years.
15 years. Okay.
And
is there a program that the buyer has to attend?
yes,
Like
they've the city and the county both have a program. I think the county's is mostly online. The city is usually in person, but I think they do have some online options.
And Steve, what's the difference between Hometown Heroes and the SHIP program?
Money. The SHIP money is much larger. The Hometown Heroes, when it rolls out, is usually 5% of your loan amount. So if you're doing, $200,000 loans, 10 grand.
Which is significant.
Yeah, I mean, it's
It's
nothing to
helpful.
sneeze at, but, and I'm sure you've seen it on your Facebook feed where people are advertising for the Hometown Heroes already. There's just one little itsy bitsy teeny weeny problem with that. It hasn't been approved yet. And it probably won't be approved for what it was previously. We had just received word that it'll probably be 50 million versus 100 million, and maybe go back to being more occupation specific. When that program first rolled out, it was for the Hometown Heroes,
Firefighters,
teachers, military, and then they kind of opened it up to everybody within a certain income limit that had a job with a base here in Florida. But I think that's going to be changed again. So, but we don't know.
Right. It has to go through the legislature.
Yep. We're hoping to hear something this week, but it probably is not going to be rolling out July 1st.
And is that fully forgiven after a certain amount of years? You have to pay that back when you sell the house.
The only program I'm aware of through that was ever forgivable was the Hurricane Michael loans.
At 20% a year for 5 years.
Yeah.
That helped people out a lot.
It does. But, think of it this way. If you're getting that money through the Hometown Heroes, it's kind of like, a VA loan is a no money down loan. So veterans do that where they have the house and then they sell it, and whatever the difference is between what they owe versus what's available. And same thing with the Hometown Heroes. You're doing the same thing, except now you're not having to come up with maybe that down payment and assistance.
Well, especially in a buyer's market, obviously sellers are more willing, I would think, to give concessions right now. But say if you have like
They've
a hometown,
become way more flexible.
right? So you could have Hometown Heroes or even the SHIP, and they would cover your down payment and closing costs, and then that means you can get money off the actual purchase price of the property.
Well,
and, to lower that offer amount. And it just helps the buyers all around.
Well, here's one of my favorite things I love to do. For the active military guys or the veterans, if it's the second time that they use a VA loan, they're going to pay a VA funding fee of 3.3%. On a $300,000 or $400,000 loan, that's a lot of money. If they take something like the Hometown Heroes money, let's say that you get the seller to cover their closing costs, they can then take the Hometown Heroes money, use that as 5% down. That cuts their funding fee from 3.3% to 1.5%.
Oh, wow.
That is a huge difference,
Yeah.
particularly when the market's a little slower and you're not getting the instant equity you used to.
Right. And these are all would you consider them like second mortgages?
Yeah, that's exactly what it is.
Cool. Yeah, I remember Hurricane Michael, man. That hurricane, I used that. Actually, the very first home I sold to when I was a buyer's agent, he used $15,000.
Yeah.
And he's still in it, so it was fully
Yeah.
forgivable now, because it's been the 5 years, because it was at 20% per year, and it was incredible because he didn't have to bring anything to closing.
Yeah.
And that was when market conditions were actually in favor of sellers. And so I can only imagine what it's going to do now to even help buyers in this buyer's market. So how much do buyers typically need for a down payment? And how much do they need for closing costs? Obviously, is different for VA, FHA, conventional. If you could kind of expound on that.
So, one of the biggest myths out there is you have to put 20% down on a conventional loan. That's not true. But for some reason, it just stays out there. You can get into a house on a conventional loan with 3% down. You can do it with 5% down, 10, 15, just depending on your credit. You can do an FHA loan with 3.5% down. Or there's another FHA program that we've got at Guild where we'll provide the down payment as a second mortgage. So if you're doing a $100,000 purchase, not that there's such a thing in Panama City, that $3,500 down would sit there as a second mortgage that they make payments on. Then you've got rural development, which is a no money down program that not a lot of people use.
The USDA.
But Lynn Haven is considered rural.
I know. And you can pull it up online. There's maps that you can look and just type in the address to see if it's...
Yes, and by nobody's stretch is Lynn Haven rural, but you can do the program. And you've got VA loans, obviously. There are so many programs where people think they can't do it. But again, if they have the conversation, I can tell them. And as for closing costs, I'd say a pretty good rule of thumb is 4 to 6%. The higher the purchase price, the lower that percentage is. Again, if you're buying a $100,000, $150,000, $200,000 house, those seller concessions go a lot quicker than if it's $400,000. Because think of it this way: if you're buying a $200,000 house and you're buying it in the Cove, your insurance alone might be $3,000 to $4,000. Well, that's a big chunk of those seller concessions right there.
So it's situational. I always try to, because we get this a lot. We have closing cost estimates. This is how, and you correct me if I'm wrong, because if I'm doing it wrong, let me know, because I'd like to correct it. But say someone's doing FHA, they're like, Casey, what are my closing costs going to be? Okay, if you're going to put 3.5% down, that's 3.5% down payment, and then approximately 3.5% for closing costs. So about 7%, approximately. This is like elementary math, quick math off the top of my head. If I get in front of a computer, I can get you a more, a better estimate with prorated taxes and all that. But is that, would you say that's a good?
I would probably boost those closing costs up. So.
Really? Well, I know for mobile homes, we ran into this because that was something that I had to learn is for mobile homes, what typically would be 3.5%, 4%, for closing costs on top, and then down payment. For mobile homes is like 6%.
You've got structural engineer reports, septic inspection, well water. I mean, retiring the mobile home. I mean, it just keeps adding up.
So for a mobile home, you're probably looking maybe 9%, 8%.
I think at 6%, you're probably.
I'm talking about with the down payment and the closing costs.
Oh yeah. Now you're
because that's what people want to know. They want to know what their all in is.
Yeah.
You know what I mean? So you're saying, if it's just regular single family residence or whatever, 3.5% for FHA, probably 3.5 to 4.5 in closing costs on top of that. So anywhere from 7 to 8%. You can do that simple math too. You can do it on the listing side as well, which I do a lot. Like, I don't know, whatever the commissions will be, 6, 7%, whatever it is, and then another 2% for title stamps and title insurance. Doc stamps on the deed, title insurance. So you're looking at 8, potentially 9% of the purchase price.
Fun fact I didn't go over with the Hometown Heroes eventually when that rolls out. One really cool benefit of that, you don't have to pay doc stamps and intangible tax under that program.
I didn't know that.
So that's what, another half a point, a little over half a point that you don't have to pay.
Wow. Yeah.
And that's significant because that stretches that assistance a little bit further.
How long does that last? Like, I know you say it depends on how much is funded, but you're saying maybe $50 million. How quickly does that go?
Oh my God. So you're talking quickly, every loan officer in the state of Florida has access to it. Now, when it first rolled out, it took longer because it was more specific to firefighters, teachers, military, police, that type of thing. So I think last year the money was exhausted by September. But, and this doesn't always reflect well on my people, the loan officers, unfortunately, the money didn't truly get exhausted until December. Because what happened is there was a lot of fall through where people were locking in the people and they probably didn't qualify for the program. You know, under last year's version, you had to work at a Florida based company. If you didn't, you know, maybe you worked at IBM, but you work here in Panama City. Well, IBM doesn't have a Florida office. So, oops. You're all the way through, and then they're like, hey, yeah, this person doesn't qualify.
Tell me more about locking in. So the money is reserved for that buyer when they're pre-approved? Or how does that
No,
work?
you can't lock their reservation until they're under contract.
Okay.
Because otherwise, every loan officer in Florida would be like, all right, Timmy, Jimmy, Mary, locking it all up.
Right.
You got to have that contract.
Okay.
Cool. Thank you, Steve.
So Steve actually put together this, it's a rate buy down example. It was actually something that I requested. It was on one of my listings. We're having a hard time moving it. So I wanted to see kind of analytically the numbers. I wanted to see how much you could save by, instead of the seller contributing, you know, to the closing cost, or, I mean, it's closing cost, but instead of actually, what am I trying to say? Instead of actually price off the purchase price, they're actually buying that rate down from, like, say, a 6.5% to a 5.5%. So
yeah, because one of the things that the listing agent has no idea about is what my buyer needs.
right.
Does my buyer need a lower purchase price? Because, you know, maybe if they're military and they're going to be leaving in a couple years, lower purchase price might be the thing. Maybe they need a lower interest rate. Okay, so now we need to do a buy down. Or maybe what they really need is they've got the money for the down payment, but they don't have the money for closing costs. So they really need closing cost assistance. You don't know what they need.
Right.
So what this thing here did is it showed, all right, here's if they just did a normal offer and they didn't get anything. And then it's like, okay, well, what if we lower the purchase price by $15,000? And then we had in column 3, I think it was rate buy down, where we said, okay, we're going to use the $15,000 and buy down the interest rate. That the buyer will save more money per month on a rate buy down than they would if they had simply got the purchase price lowered. So then in the 4th column, I was like, well, what if they could afford that payment with the higher rate? If they paid that extra $130 a month on their mortgage, but with the lower interest rate, their balance would catch up to the lower purchase price in 5 years.
That's incredible.
So in 5 years' time, if you're paying $131 extra on the principal each month, because it's at a lower interest rate, you catch up by the 5th year. So your balance is exactly the same as if you'd gotten it $15,000 lower.
To me, it doesn't make sense if you're going to buy this house and you're going to sell in 2 years. Like, this is something you probably, if you're interested in a rate buy down, this is something you want to stay in for several years.
Yeah,
you know.
The point I was making was that if you're sitting there and you're doing that extra $130 a month, your principal reduction would be $145,562 over that time versus $109,000.
Wow.
That's a lot of money for
Yeah.
just $130 a
Right.
month.
And because if you look on the first page, if you just reduce the price, your monthly mortgage payment would be about $2,711 versus where am I at? $2,580 a month. So it's about $132 a month that you're saving by taking like a 6.5 interest rate to a
Right.
5.5 by buying that down.
My favorite thing I like to tell people lie, math doesn't.
Right.
So let's just look at the math, and whatever makes sense, we'll do.
And what makes sense to me is just looking at amortization as an entirety. Like the beginning, you're paying all the interest up front.
Yeah.
So this is a way to pay less interest, which affects your bottom line.
When you look at an amortization and you see, like, let's just say you were getting $500 in principal reduction, and then you see how many years it takes until you would get $600 in principal reduction, it really illustrates how much that extra $100 a
Huge.
month makes over time.
Absolutely.
I remember a couple years ago, I had a buyer who is very analytical like this. He wanted to see the numbers to see what worked, and you did a full video for him and showed him the breakdown for each scenario, and I loved
Yeah.
that.
Yeah, because that's what those people want. They're all into the just show me the math.
Yeah.
I appreciate everything you have to say, but I want to see the math.
And I think more people need to have that
Think
mindset.
about the future. Yeah.
Yeah, and because I feel like if you showed them the math, like if somebody really looks at this table that you put together, like, oh my goodness, we plan on being in this home for 15 years. This makes more sense.
Yeah.
You're saving thousands and thousands and thousands of dollars.
Oh, and then it makes it so much easier when it's time to sell,
Absolutely.
which is where it goes right back to you. Because if I've increased that equity along the way, it gives you guys more room to maneuver.
Absolutely.
Definitely.
So what is an FHA 203K loan and how is it beneficial to home buyers?
So that's a loan I haven't done a ton of, but what it is it's a loan, it's a rehab loan where you can get money to fix up the house. And one of the cool features of it is, again, let's just say you're buying a house for $100,000. Your down payment is based on the purchase price. So even if you got $100,000 worth of renovations done to the house, you don't have to come up with $7,000 down. It's just the 3.5%, just the $3,500.
How does that work? So you get estimates while you're under contract, it goes into escrow and then paid out once the work is done?
Yeah, that's the painful part. The fun of this program is finding a contractor that will give the estimates in a timely manner in the way it has to be done. And then it basically kind of works like a construction loan. You close the loan, the contractor gets a certain amount of money up front to start. Then an FHA consultant comes out, verifies the work was all done in a proper manner, and then you get cut for the next round.
This could be beneficial in, our market when someone's working in a certain price range and they need maybe a little help with the house to fix it up. Now, the amount that the contractor can spend on fixing it up, is that set within
Based
the
on
Yeah,
terms
they're
of the
giving
loan?
you, hey, we're gonna spend, and they do put money, they do set aside money for rut-row, for okay, we underbid this, so there is some money set aside for that. But yeah, if you say you're gonna do the work for $100,000, don't come back for 50 because it's already closed.
Yeah.
I think there's a misconception with like fixer uppers and handyman specials. There's a misconception that, oh, it's only cash only. And maybe the seller's only going to accept cash. That's a different scenario. But this is a way where you can get into a fixer upper and you might not have cash for it. In this
Right.
program, it'll help you, have that extra, maybe it needs a bathroom. Maybe it needs a kitchen.
This was used a lot after Michael.
Absolutely, yeah.
The structure was there, but could have some issues.
Yeah.
Yeah.
What are some red flags buyers should watch for when choosing a lender, in your opinion?
They won't give you a straight answer.
Yeah.
If I call up Heather and I say, what's going to be my rate, my payment, and closing costs, if you're hemming and hawing and not wanting to give me a solid answer, you probably ought to have your radar up.
Yeah.
Yeah.
To me, that's most of the time, all the lenders are probably pretty close on interest rate. Every once in a while, someone will have a really great special you can't compete with, but I imagine if you call us, Trustmark, Regions, we're all going to be pretty close. But if you find someone that's absurdly low, that's when you need to be like, why are you 5.25% and the rest of the market is 6.75?
They probably have them buying down the rate or
Oh,
something.
if you,
Look at those numbers
Yeah.
closer.
Yeah.
What should buyers know about locking in their rate? How long can you lock in a rate?
so you can lock for a long time,
Mhm.
but the further out you lock, the higher the rate is. Because as lenders, we're guaranteeing, we're saying we're bringing this home. And so a 15-day lock is going to have a lower rate than a 30, than a 45, than a 60. What I usually tell people is if you're comfortable, lock it. Just, I have only bought 3 houses, but not one time, not one single stinking time, and I'm in the business, have I ever locked at the bottom of the market when I was buying. But that didn't bother me. If I, like on my current house, I've got 3.875. If it had gone down to 3.625, whatever. Not a big deal. But if that rate had even gone up an eighth of a point, that would have frosted me forever.
Mm-hmm.
Every time I made that payment, I'd be like, Steve got greedy, cost him money. And it would have just made me mad every single payment for the next 30 years. So, but the thing about a lock is, if the rates do go down, I've already locked you. That's the give and take. I'm locking in, you're secure. So if the rates go up, hey, you're good. But if the rates go down, we're still here. Although I will say, traditionally, when the rates go up, it tends to be a lot faster and harder than when they go down.
Yeah.
Are you locking in rates like as soon as you how often are you locking in these rates for buyers in the current market that we're in?
I like to send them their documents, take a look at it, and then if they're good with it, I'm like, okay, let's go.
Let's do it.
Let's lock. But it's their call. I don't. I let Casey decide. Okay,
Right.
Casey, do you want to lock? Okay, Steve, what are the risks? What the risk benefits, all that stuff. But bottom line, that's your call, because I just have to be able to sleep at night.
Yeah.
Absolutely.
And
yeah.
if I cost you money, then I can't sleep.
Yeah, because it could happen where you're like, oh no, the rates went up. Now my monthly payment's up. What happened? Well, we didn't lock in your rate.
Years ago, when Donald Trump won his first election, I remember right before election night, I was sitting there staring at half a dozen loans. I'm like, lock, not lock, and I locked them all. Well, when he won, rates jumped up. And then a lot of the loan officers were like, well, they'll come down soon. Because sometimes you see that where they go up and then, well, they didn't come down. And they kept not locking. And so now suddenly you've got to go to that buyer and be like, yeah, not only did I not lock you when I should have, but then when that initial damage happened, I didn't pick up the phone and call you then. And now you've made a bad problem worse.
Steve, I have a question. When a buyer goes under contract on a property, when do you put out the good faith estimate? And when do you also lock their rate? Which comes first?
Well, you got to get them the estimate first.
Okay.
You got to get them that estimate. We try and get them out within 24 hours. Most people get them out at least within 3 days, because the buyer needs to know what's my rate, what's my payment, what are my closing costs, because at that point everything is getting okay. Now it's go time. Now the only thing we usually can't really tie up yet is the homeowner's insurance, because if the house is a certain age, a lot of times the insurance people can't give you a really great quote until you have the 4-point and the wind mid. So when I have an older home, when I'm just doing a quote, I'm usually estimating at least $300 a month.
Yeah, that sounds about right to me. Yeah.
What are the hidden or unexpected costs buyers should budget for at closing?
The biggest surprise, again, tends to be homeowners insurance. If you're, and this is where, a lot of times realtors will tell their buyers, hey, don't use an out-of-town lender. Because if you work for a certain lender that's internet based,
Mm-hmm.
they have no idea what insurance is in Panama City, Florida.
Yeah.
So they might be quoting them $100, $150 a month for homeowners insurance. And unless it's a brand new construction, that is just not going to fly. So they're going along, and suddenly that premium comes in 250, $400 a month. Well, that'll blow your deal right there. Or even if they could still do it as a lender, the buyer might be like, I can't make that payment. And so I would say insurance is the biggest surprise.
Yeah. Yeah. I just had one where a buyer went under contract. It was a 1936 home.
Oof.
And the listing agent said the seller currently pays $1,400 annually for insurance through Citizens.
Oh.
But came down to it, he actually got a copy of their insurance premium, and it was more like $3,600 annually. And I was like, that sounds a little more on par with what we were thinking. So yeah, I'd agree. That's definitely the most unexpected cost whenever you're quoted something wrong
Yeah.
from someone who doesn't know. Sorry.
Oh, what's the most common reason a loan gets delayed or denied?
You know, the delay thing, and you got to be really careful here because everybody wants to know what's going on, the listing agent and the buying agent. You have to be careful what you tell the listing agent, but they still need to be kept in the loop. But a lot of times, your biggest issue is getting the stuff from the buyer because, you know, maybe they go under contract on a Wednesday. We send them the stuff. They get it that, you know, here's your items needed list. Here's your doc. So they're like, oh, okay, well, I'll get it to you over the weekend. And then you walk in Monday and it's still not there. And so, you know, people at that point are like, hey, how's it going? How's it going? And it's like, I really need Jimmy to give me my stuff. And at that point, a lot of times I'll sick my buyer's agent on them and be like, hey, Casey, would you mind giving this guy a call and letting him know we close in 30 days and I've almost lost a week?
Right.
Because if I don't get that stuff, well, it's not realistic to expect every loan to be underwritten in 24 hours. You're not giving the process enough time. So a lot of times that's why I like the pre-approvals, because then I've already got the income, the pay stubs, the W-2s, the employment verifications. So I would say that. And then a lot of times, and I don't know why, but sometimes it takes a long time to get an appraiser to pick up an assignment, which is weird because it's not like we're slammed, but every once in a while, for reasons you don't know, like maybe it's a house in Lynn Haven and nobody's picking it up. It's not like a rural home, you know, out in the sticks, and it's like, okay, can somebody pick this up, please?
In those cases, do you guys increase the fee to make it more attractive?
We will ask,
for
so
the
we have to
appraiser?
go through a third-party management company, because if you talk to an appraiser directly, you get hung
Okay.
from the chimney with care. So you will be like, hey, what if we increase the price? And you know, finally you get somebody to accept it. But at that point, I'm usually on the phone with both agents going, hey, listen, we did order it here. And most of the agents, if they've been around long enough, they do understand sometimes, okay, it's not being picked up, but we can't do anything without that appraisal.
Yeah.
Yeah, I mean, there's a lot of paperwork too. Just going back to when you're going through the loan process, which when I bought my first home, mid-20s, it was a lot.
Yeah.
And that was with somebody that knew computers. That was with somebody that knew how to operate an iPhone.
And by the way, it hasn't gotten any smaller.
Oh, I agree. And so, like, what I've seen is kind of the older folk that are buying. They're like, dot loop, what's dot loop, or
Yeah.
DocuSign, or they're like, can we just go in person? Can you go in person with me to meet my lender? And all these things is because they don't know how to operate a computer, or maybe they do, they just don't know how to fill out those forms,
Or they don't trust it.
Right. Yes. So I'm sure you deal with that a lot too. So it's definitely, even like I said, someone that's very knowledgeable with technology and things like that. It's
Yeah.
still, you know, you have to you're buying a house. It's significant. So you have to definitely make the time for that, you
Yeah,
know.
put a little work in.
Yes.
And we're asking, I mean, we are going to ask for stuff.
Yeah.
Right. Yeah.
What I love is when a buyer is calling me saying, do you have an update when you've called them to turn in their paperwork? And I'm asking them, did you turn in the paperwork that they asked for?
Yeah,
And it's
because I've
just
already
circling.
tattled. I've already thrown them under the bus.
Yeah.
Hey, Heather, they're not playing ball.
I think everyone's so busy. You
Yeah.
know, we always have, you know, a lot of people work full time, the 9 to 5, Monday through Friday. So then on the weekends, they just want to chill or go to the island
Right.
or whatever. So that's like, but I always tell my clients, like, make it a priority.
Mm-hmm.
It's only for, and this is one of our questions, you know, how long is the typical loan process? But typically what, 30, 45 days?
I always tell them 30 to 45
I need
days.
to
Yeah.
be number one in your life for 30 to 45 days.
Exactly.
Yeah.
That's a good way to put it. Hey,
When
just
you see when
30
you
or
see me
45
call,
days.
I'm not calling just to hang out.
Right.
Yeah.
Right.
I want something.
Right. Yeah. Just, you know, grit it out, get what you need to get done, and then you can go back to the island the next weekend.
There you
go.
You know what I mean?
Yeah.
So,
What advice do you have for self-employed buyers?
Show your money. The biggest thing with self-employed borrowers, it's such a tightrope because you want to show as little income as possible to Uncle Sam, but you can't tell me you make 200,000, but your tax returns only show 50.
right.
There are some things we can add back in as income. Depreciation, we can add that back in as income. Mileage, we can take a portion of that, add that back in as income. But sometimes you're just going to have to bite the bullet and show your income. You just have to. Because again, I can't qualify you for this house if you make this income.
Right.
How do self-employed buyers usually show their income? Is it only taxes by proving their income, or is there
so
other
there are
ways?
other programs. There are bank statement programs where you're going just off the deposits in the account. There, that's a big one for them. But like anything, it's risk-based. You can show me your tax returns. Casey gets a lower interest rate than Heather, who's just showing me bank statements. So yes, we can do it, but that's what you're giving up something, because you can't have it all. You can't not show your income and expect the same rate as Casey, who's showing her income, paying the taxes, all the things. So that's the tricky part.
I think, I mean, let's just talk about a contractor, though. It's like, and I have this conversation all the time. Your gross is not your net.
It is not.
So contractors, subcontractors, they pay out. I mean, oh, I make this much. Well, really, you don't make this much. You actually make this much because you're paying Jim, Sammy, and Sandy over here to do a lot of these jobs. And so, you know, that's what you guys are looking at, is how much do you actually make? And while we're on this topic, what is this whole thing where if you're self-employed, you have to be self-employed for at least 2 years? Can I,
Okay.
like, if I became a realtor tomorrow, could I qualify for, because we're self-employed, could I qualify for a home loan?
No. So a couple things on that. One, the reason they want 2 years is to show some consistency.
Right.
You know, maybe you started out as a realtor, during the time when the interest rates were really low a couple years ago, and it was shooting ducks in a barrel. I mean, how many Facebook posts did you see? Hey, listed this house today, got 6 offers, all overpriced. I'm awesome. Call me up.
Yeah.
And then the following year, it's like, hello, I listed this.
Is anybody listening to
Will
me?
somebody come buy it? So suddenly you might have gone from making $150,000 to $50,000. And then the other thing we're looking at is it's not just a 2-year average. We want to see, did your income decline? It'd be one thing if you started at 50 and then went 150. We don't like you to start at 150 and then drop to 50. That doesn't give you a big warm fuzzy. But going backwards just a little bit, when you're talking about the pre-qual versus pre-approval, when I'm talking to a self-employed borrower, before I rip off that pre-qualification letter, I'm probably going to call Casey and Heather and go, hey, listen, this is what he says. But before you go showing him homes, I want to see the tax returns. Because as both of you know, just what you were saying, a lot of them they give me the gross, not the net. It's a little more, you feel a lot more comfortable about when the person tells me they make 75,000 a year and they're W-2'd at XYZ company. Then, when it's self-employed, I want to see that backup before I have you guys go out there and you're spending your time and your gas.
Absolutely.
And then I sit there and I get the tax returns and it's like,
wait a second.
Yeah.
so what homes were you showing?
That's when their pre-qual goes from like 450,000 to 230,000.
Which is so important to have, because you don't want to show someone a $400,000 home that can only afford a $250,000.
It's
Yeah.
wasting your time, but also that seller's.
Oh, then any home you show them the $250,000 range is not significant.
Yeah,
it doesn't.
It's tough to buy the Corolla when all you've seen are Cadillacs.
Exactly. Yeah.
Absolutely.
So.
When I was pregnant with Scarlett, so circa 2017, we were buying a home in the Cove, our first home together as a family. And I had to share all my bank statements with the lender, but I was pregnant and I was so embarrassed to send it because the amount of Chick-fil-A charges on that bank statement was embarrassing.
Love Chick-fil-A.
It had to have been every other charge. I
So,
loved it.
They added that as an itemized expense.
This is one of my favorite things I tell people that don't have down payment money. I always tell them, you show me your Taco Bell bill, I'll show you your down payment.
Yeah.
Yes.
It was
And I
all
ask
in
them, I say, right before I got here, I was talking to a client. I said, go through your last 2 months' bank statements. You tell me how much your fast food bill is.
Yeah.
And that's because you're looking and they make the income. They don't have much in debt, but there's no savings. And usually people spend what they make.
Absolutely. Yeah. I think right now the subscriptions are getting me, because it's like, do we really need Hulu,
Disney,
Amazon Prime, Netflix? Do we really need 7 streaming?
It started off cheaper with no cable, and now
I know they're onto something. So tell me how jumbo loans work and when are they necessary?
So you do a jumbo anytime. I think in Panama City it's like $870 something $1,000. Anytime you're over that loan amount, you're paying jumbo. Okay, that means usually a little higher interest rate because it's a higher risk. Now, what's fun sometimes is, and I've done this in the past, where you're like, maybe the guy's putting a certain amount down. I'm like, listen, you can squeeze out a little bit more money. We can take you from jumbo just to normal conventional. And usually when you're buying in a jumbo market, when you can afford that, you could afford to put, in some cases, a little extra down to get you below that mark. Jumbos are fine. They're just a little more difficulty. Depending on the house, you might have to get 2 appraisals because there's a lot more risk. And, like we said, everything, there's a risk.
Absolutely.
What common myths or misconceptions do you hear from buyers?
Kind of going back to what we thought earlier, which is, I got to put 20% down. I've got to put 20% down. There's no assistance for me. There's no help. There is. Particularly now that we're in a buyer's market, sellers will oftentimes give you seller concessions. So if I can get the seller concessions, now all I have to do is figure out the down payment. And again, maybe I'm doing a Florida bond loan. Maybe it'll be a hometown hero. Maybe it'll be a ship loan. Maybe it'll be the FHA where we do a second mortgage for the assistance. So that's probably the biggest one.
I bet you have a lot of stories where you've helped buyers achieve their goal of home ownership by putting those programs in front of them.
Yeah. I've spent a lot of time working with people on their credit. I do remember, though, years ago, and this one kind of hurt my feelings. They called me up and they're like, Steve, thank you so much for all that help. You got our score from 550 to, 680, whatever it was. She goes, because of your hard work, we were able to close the loan with Regions.
Oh my
And
gosh.
I'm like, that's really great.
Yeah.
I'm
Just
so
smile
glad that
and-
worked out for you.
Well, and I think that's the same like with us when we have like a best friend or like a family
Yes.
member use another realtor. You're like, I just bought a
Awesome.
house. And you're like, I am a realtor.
Yeah.
Me and Heather are realtors over here. Just if you didn't know.
Yeah.
But I think, when you go back to that stat, which this is not approximate, but approximately the net worth of a renter is $10,000 versus the
Yeah.
net worth of a homeowner is like 42 times that. So like $420,000. The amount of people that you've been able to help, which directly influences their life and their wealth,
Their legacy.
their legacy.
Yeah.
And
Even with this down market, I have a
Mhm.
program and I send it to my buyers where they go under contract. I send them a real estate report card. Even in this market, it's showing the cumulative appreciation over the next 5 years to be over 20%.
absolutely. Yeah,
And that's in a down market. And it's
absolutely.
still showing it.
Absolutely. Yeah. I would say on average 3% a year, but 4 to 5 to 6% a year appreciation is not unheard of. And
Right.
I think a lot of people miss that part.
Yeah.
They don't understand the appreciation aspect of it. And, people that are, oh, we're going to wait for interest rates to lower. It's like now is the time to buy.
I'm glad you brought that up. It's another little toy, but it's called cost of waiting. And I will send this out to buyers that want to wait, which is fine. But when you show them, okay, here's what happens if you buy the house now. If you wait a year and interest rates drop, well, now that house is probably being priced here. Your insurance has now gone from here to here. Your property taxes have also gone up. You have also lost out on appreciation and amortization. Amortization is the equity you build during the time you own the home. And so it's not just payment driven. You've lost. I mean,
Yeah, you're behind. They think they're saving, but you're actually not. You're actually losing.
Mhm.
right. And then suddenly that interest rate differential isn't saving you what you thought when you factor in, man, oh, and by the way, because your purchase price went up, well, your closing costs have now gone up.
Absolutely. Well, thank you so much, Steve, for
Thank
coming
you.
on. Where can people reach you? Where can people contact you if they're interested in purchasing a home and getting pre-qualified?
Yep, easiest way is on my cell phone, which is 850-819-2149 or 850-215-LOAN,
Okay,
which
so
is
he's giving out his
5626.
cell
There you
phone,
go.
and he does answer. And if he doesn't answer, he's with a client, and he'll call you back.
Yeah.
I will.
And you also have a Facebook page, or how can people
Yep.
find you online?
SteveDick.com,
Okay.
and then obviously on Facebook.
Over 25 years in the business. He knows his stuff. Please reach out to Steve. He's helped us several times
Yes.
with our clients, and we really appreciate you coming on.
Thank
Thanks,
you so
guys.
much, Steve.
Thank you.